It's Thursday pre-market, and we're talking Opendoor. After a bruising Wednesday session that saw the stock drop nearly 25% and close at $1.87, there was some stability in the aftermarket, with Opendoor clawing back a cent. It's not much in the grand scheme of things, but it's a sign. A sign that things might be cooling off after the knee-jerk post-earnings reaction, and that perhaps, just perhaps, the market is beginning to reassess the bigger picture. Let's recap quickly. Tuesday's earnings were actually pretty solid. Opendoor reported selling over 4,200 homes with $1.6 billion in revenue for the quarter, up 5% on Q2. Gross profit came in at $128 million, and contribution profit was $69 million. Most notably, the company achieved adjusted EBITDA profitability for the first time in 3 years, at $23 million. That's not insignificant. That's a sign of operational tightening, smart scaling, and, frankly, resilience in a tough market. But what happened? The stock tanked. Not because of the earnings themselves, but because of the softer guidance for the back half of the year. Management said that they expect acquisition volume to be lower due to elevated interest rates, meaning fewer homes purchased and tighter inventory. That's a function of macroeconomic conditions, not necessarily business missteps. And to be clear, this wasn't unexpected. Real estate is cyclical. Q4 is always softer, but some media outlets took that commentary and ran with it, creating a bearish cloud that engulfed the stock. Combine that with the natural volatility of post-earnings sessions and a big retail presence in the stock, and the result was a sharp sell-off. But let's not forget what happens after those types of moves. Sometimes, the smoke clears, sentiment resets, and buyers return. That's why the modest aftermarket gain on Wednesday is worth noting. It suggests that some traders, and possibly even institutions, aren't ready to throw in the towel. They're stepping back, assessing the results, the forecast, and the broader environment. Which brings us to what's ahead. There's growing momentum behind the idea that the Federal Reserve could cut interest rates as early as September. That's largely due to the string of weak job data coming out this week. Job openings are falling, wage growth is slowing, and the labor market, while still strong, is no longer as overheated. That gives the Fed cover to begin easing, and if that happens, it could be a major macro tailwind for Opendoor. Lower interest rates mean cheaper mortgages. Cheaper mortgages mean more buyers entering the market. And more buyers mean increased transaction volume, which is exactly what Opendoor needs. Remember, their model is built on home turnover. If rates fall and demand picks up, Opendoor can resume buying and selling homes at a higher clip, improving both top-line growth and margins. So here's how this could play out. Scenario 1, the market overreacted on Wednesday. Retail, and maybe even some institutions, begin to buy the dip on Thursday and Friday. They see the solid Q2 performance, understand the macro picture, and realize that the earnings call didn't reveal any structural weakness in the business. In fact, the call showed that Opendoor is adapting to the rate environment, managing risk, and still hitting profitability metrics. If enough traders come to this conclusion, the short squeeze narrative could reignite, and we might see a sharp rebound. Scenario 2, the sell-off continues. Negative headlines from yesterday continue to linger, and traders remain cautious. That's a possibility. But even then, the stock could find a floor, especially as rate cut odds increase. Savvy investors might take advantage of the lower prices to build positions ahead of what could be a stronger Q4. Either way, the longer-term narrative remains intact. Opendoor is adjusting to the interest rate environment, achieving profitability, and positioning for scale. That's not something to overlook. And it's not just retail noticing. Eric Jackson of EMJ Capital appeared on Yahoo Finance in the aftermarket session and made some interesting points. He suggested that while he remains bullish on Opendoor's long-term potential, a change in CEO could possibly help the company better navigate the next stage of its evolution. Now, Jackson wasn't throwing shade, he was simply saying that the business model has legs, and perhaps some fresh leadership could unlock more value. That's a notable comment from a high-profile investor, one who has been both critical and constructive in past calls. His remarks point to a larger truth: Opendoor's story isn't broken. It's evolving. And with the right catalysts, including macro shifts and internal adjustments, the upside remains considerable. Also worth noting, Opendoor has fully regained compliance with the Nasdaq. The reverse split vote was cancelled, a move that signaled confidence from the board and removed a major overhang. No dilution. No panic reverse split. Just stability. And that's important, because for retail traders, confidence and momentum go hand in hand. We've seen this story before: heavily shorted stock, improving fundamentals, media negativity, and then a rebound powered by conviction buyers. The question is, where are we in that cycle? Wednesday might have been the sell-off climax, or it could be part of a broader digestion process before the next leg. One thing's for sure, Q3 and Q4 will be crucial. If rates come down and Opendoor is able to ramp up acquisition volume again, the back half of the year could outperform the modest guidance we got this week. The company is already leaner. It's already profitable on an adjusted basis. The only missing piece is volume. And volume returns with better rates. So what should we be watching heading into Thursday's trade? First, price action. Will the market continue to punish the stock, or will buyers step in and defend the $1.80s? If there's accumulation early in the session, it could set the tone for a recovery. Second, macro headlines. Any comments from Fed officials or new data on inflation or employment will move rate cut probabilities and, by extension, stocks like Opendoor that are sensitive to housing demand. Third, social sentiment. Opendoor remains one of the most discussed tickers on Reddit, StockTwits, and Twitter. If retail voices start framing Wednesday as an overreaction, momentum could shift quickly. These platforms move fast, and so does sentiment. Bottom line, the dust hasn't settled yet, but we're starting to see the contours of what might come next. Eric Jackson's comments, the aftermarket stabilization, and the broader rate narrative all suggest that the sell-off might not be the end of the story, just another twist in the plot. Personally, and this isn't investing advice, I added to my position on Wednesday. Not because I think the stock will rocket immediately, but because the fundamentals are improving, the company is maturing, and the macro winds are shifting in its favor. It's a bet not just on a bounce, but on a turnaround. So let me know what you think. Are you holding through the volatility? Did you add more shares? Or are you waiting for confirmation before jumping in? Drop a comment, like the video, and subscribe if you want to stay up to date on Opendoor and other high-conviction plays. We'll be tracking this closely, and with more earnings coming in and Fed decisions looming, the next few weeks could be crucial. Thanks for watching.